Hello, good morning, everyone.
Good
I
morning.
yes, I
Good
see
morning,
seven.
madam.
Good morning, good morning. So I see 17 people logged in. Shall we start? So the others will join later, I guess. Is it all right?
Okay, madam.
Okay, can you all hear me clearly?
Yes, madam, we can hear you.
Okay, thank you very much. So last week we were talking about valuation of assets. So how you value assets, like we identified or we learned a general theory of valuation, that is for any cash flow generating asset. For any cash flow generating asset, the value of that asset is the present value of the cash flows generated by that asset, right? So under that, we learned how to value a bond. So, and different types of bonds. So one was the zero coupon bond, where only one cash flow would be generated by the bond. And the other is a perpetual bond, where a series of interest payments will be the cash flow generated by that bond. And then we learned a bond where two types of cash flows are generated, where one is the coupon flow, the other is the value at maturity. And now today we will look at how to value a stock, right? Or an ordinary share and a preference share. So stocks and their valuation. Okay. So topics covered we'll be talking about features of common stock, determining common stock values, efficient markets, and we'll talk about preferred stocks, right? Then facts about common stock. These are commonly known by everyone, right? But for the sake of completion of the lesson, I have included these. Represents ownership. Now, normally we all know that common stockholders are considered as owners of the company, right? So ownership implies control. Stockholders elect directors. Directors elect management. Then management's goal is to maximize the stock price, right? So I think in your very first lesson, Professor Veerapon would have explained this to you very well, right? So how um, maximizing the stock price helps us achieve the goal of the firm, right? So ordinary shares represents ownership. Ownership implies control. That means owners have a right to influence the operations of the business. So how they influence is by electing the directors. So directors in turn, appointed directors would in turn elect or select the management. So management will we expect that they will try to maximize the stock price for the ordinary shareholder or maximize the wealth of the ordinary shareholder. So can you all give me an answer to this question? Should management be equally concerned about employees, customers, suppliers, and the public, or just the stockholders? Should management be equally concerned about employees, customers, suppliers, and the public, or um, just concerned about the stockholders? What do y'all think? You can, if you do not want to talk, you can always type in the chat box.
Madam, I think according to my knowledge, I
Okay.
feel like we should give good concern for each and every party, not just the stockholders, because when we are working as an organization, we are working in the society.
Yeah.
Therefore, because of our activities, most of the parties are infected or whatever the negative impacts are there because of our business entity. So we should give a great concern for each and every party in the society, not just the stockholders.
Okay, that's a good idea. Then there is another message in the chat box: maximizing the wealth of the stockholder. So what he or she says is, we must concentrate on maximizing the stockholders' wealth. Right? Any other idea? Yes. Anybody else wants to give an idea? Yes. Yes, no one wants to talk. Yeah. So in an enterprise economy, yes, management should work for, yeah, that's yes, balance the interest of all stakeholders. Okay, another answer, balance the interest of all stakeholders. That's like what you suggested, right? Then my suggestion is, in an enterprise economy, management should work for stockholders subject to constraints like environmental, fair hiring, etc., and competition. Now, one side is now stockholders, although they are owners at the time of closing the business. If the business get bankrupt and if you have to close the business, stockholders are the least important party in getting their investment back, right? So uh, because all debt holders, employees, everybody will be compensated before the stockholder is compensated, right? So maximizing the value of the shareholder means now he's at the bottom of the list. So if you are concentrating on his welfare, so the others' welfare is already secured. Don't you think so? One can think like that. Stockholders are the least privileged party in the organization, although they are the owners, right? So when you concentrate on that bottom line and try to uplift or try to make something that is beneficial for the shareholders, don't you think the others are already benefited by that? Is one argument that you can bring uh, for maximizing shareholders' wealth, right? So sometimes one may say, okay, it doesn't happen. If you look at the stockholders only, although we think that it happen, all the others are benefited already, that may not happen, right? So there can be arguments like that. And since, after all, since it's stockholders' money, you are responsible, managers are responsible for giving them a good return, right? Maximizing their wealth has to be the objective, because it's, after all, it's their money, right? So they would expect a return for their investment. So there can be many arguments. So there is no conclusion as such. It's an ongoing argument, right? So with that, we move on. When is a stock sale an initial public offering, right? A firm goes public through an IPO, initial public offering, when the stock is first offered to the public. So you call it an IPO when a company goes to the public for raising funds for the first time. So if they are going for the second or the third time, it is called seasoned public offering, right? Seasoned public offering. Initial public offering is the first time that the company decides to raise money by issuing shares. Different approaches for valuing a common stock. So after having some idea about the stocks, let's move on to approaches for valuing a common stock. Different approaches for valuing a common stock. Dividend growth model, free cash flow method, using the multiples of comparable firms. So these are the three commonly used method, or three commonly taught methods of valuing ordinary shares, right? Valuing ordinary shares. Okay. Stock value is equals to present value of dividends. Now, how we take this? Now, I said the general rule of valuation is what? Of any asset that generates cash flows. It's the present value of the cash flows that you can take as the value of that asset, right? So this, if we apply the same principle for this, we must look at the cash flows generated by an ordinary share. So can anyone help me identifying those? Yes. What are the cash flows generated by an ordinary share? Yes, please.
Dividends?
Yes, dividends is one. Dividends. Okay. Dividends. Yes, any other idea? Now, in the case of a bond, of course, we had we had bonds with maturity and bonds without maturity. In the case of an ordinary share, does ordinary shares have a maturity? Yes.
No, ma'am.
No, it doesn't have a maturity. But what can happen is, now if a person purchases a share, right? So he is entitled to receive periodic dividends, right? Apart from that, yes, yeah, apart from that, if he or she wishes to sell the share, right? Sell the share. So there can be a cash flow, isn't it? Capital gain or loss. Loss. Or in this case, the cash flow will be the share price. Share price. Share price. Right? Agree, everyone?
Yes, madam.
Yes, right. So there can be dividends and share price. Now, if that is the case, how shall we calculate the price of the share? Price of the share, or price or the value. Price or the value of the share will be, yes. Yes. How shall we value it? Yes. Take in the general rule of valuation. How shall we value it? Say, for example, make things easier. I say you buy it on January 1st and sell it on 31st of December, right? Buy the share.
So it's like an annuity, madam.
Oh, let me explain it to you. Buy it on 1st January, 1st Jan, and sell it on 31st December, right? So you buy a share. You buy a share on 1st of January and you keep it for 1 year and you sell it. You expect to sell it on 31st of December. So what is the price that you are prepared to pay on 1st of January? That is what we use now, or we use valuation in decision making. We forecast the cash flow, future cash flows, bring them to the present value, add those together, and we decide on today's price, right? So if that is the case, now you are thinking of buying it on 1st January. Let's assume that we are on 1st January. You are expecting to sell it on 31st December, right? So the two types of cash flows that this stock generates is, after the first year, they will get an annual dividend, right? Annual dividend. Then on 31st December, he or she will receive the share price, market price of the share on 31st December. So these are the two cash flows, right? So present value or today's value will be, how shall we calculate? Now that has to be the present value of the cash flows, isn't it? Right? Can anyone help me? Yes.
Future value divided by 1 plus Rn.
Yeah. So I'm asking about the cash flows. First, identify the annual dividend. Say if I assume that we are on 31st of January, we are considering buying a share, right? Ordinary share, right? And we think, okay, I'm going to keep it for 1 year and sell it at 31st December. Okay. In that case, what are the two cash flows? What are the two cash flows? First is the dividend flow, the dividend that you would receive for the year. And then the second cash flow is the selling price of the share on 31st December, right? Now, the difference is these are expectations or forecasts, because in the case of the bond, we knew the coupon rate, we knew the face value, right? But in the case of a share, we are not aware of the dividend that the company would declare, right? So it has to be a forecasted figure. And we are not sure of the exact price at which we would sell the share at 31st December. So it's going to be another forecast, right? So estimated dividend, take the present value of the forecasted dividend, dividend plus present value of the expected price. Expected price or the forecasted price. Right? This will give us the price of the share. Do you all agree with me? Yes or no?
Yes, madam.
Okay, okay, right? Now, what happens? Now, see, taking the valuation principle. Now, what determines the expected price at the 31st of December? On 31st December, how shall we estimate the price? It will be now, today at time 0, we think price of the share is the present value of the dividend plus the present value of the expected price at the end of the year. Now, if we stand at 31st December and we decide how will this price be determined, it will be the next dividend, isn't it? It will be dividend in year 2. Dividend in year 2. Present value, sorry. Present value. Present value of dividend in year 2. Plus forecasted price. Forecasted price at end of year 2. End of year 2. Do you all agree with this? Agree with this, please? Do you?
Yes, madam. Agree.
Oh, okay. Now, this future price depends on what again? At the end of year 2, price will again depend on present value of dividend in year 3 plus present value of future price of year 3. Agree? Agree? Do you agree?
Madam, that was not clear. Can you
Yeah.
explain it again?
Yeah, let me. Now, this is 31st December. Let's see, this be here first 10 was, we are still in first 10, 22, right? And we are talking about 22, right? Now, 31st December 22. Price will be present value of D2 for the year 22, right? Dividend for year 22, for 2022. And this will be N22, price of N22, right? Now, if we stand at 31st January, sorry. So this is not, this is 23, right? Right. Did I get it correct? Now here, this is dividend for, sorry, this has to be 23. This is expected price of 22, right? If we are now here, we are on 1st January. Jan 22 is the present value of the future dividend on end of year 22. Present value of the expected price on December 22. Get it? That is clear, isn't it?
Yes.
Okay. Now, how shall this comprise, or how shall we forecast this? Now, it's a forecast now. So if we go and stand at 31st December 22, you will see it's again the future dividend and the future price. Present value of future dividend plus the present value of future price, right? Get it? Now, what is the general rule of valuation? It's the cash flows that the asset would generate, right? It's the cash flows that the asset would generate, right? So if we are thinking of selling it at the end of December 22, the cash flows will be the dividend for the year 22 and the present value of the expected price that we will receive at the end of year 22. That much is clear, no?
Yes, madam.
Yeah. So if we go and stand at 31st December, then if we are to value the price, then it will be the next dividend plus the next year's price, isn't it? If we hold it for the second year, right? and we are at the end of the first year trying to value the price, right? So it will be the present value of the next dividend plus the estimated price at the end of that year, if we are thinking of 1 year investments. Get it? Get it? No?
Madam, the last part is a bit confusing. So we are going to sell this at the end of January 2020,
Yeah.
31st December 2022.
31st December, yes, 31st December, we are going to sell it, right? Now, if you apply the rule of general rule of valuation for the price of the share at the end of December, 31st December, right? Assuming that we are keeping it for 1 year. Now we buy it today, we are considering buying a share, thinking of selling it at the end of the year. So the two cash flows identified are the dividend for the year plus the cash that we will realize as the price. Okay, with that much you agree, right?
Yes.
So at the end of the 31st December, assume that we are keeping it for 1 year again. So the price on 31st December will be year 2 dividend plus end of year 2 price, isn't it? Present value of end of year. Yes, get it? Now, if you go and stand at the end of the second year, it will be again the next present value of the next year's dividend and the expected price. Isn't it? One step further. Yeah, get it? So you will see that if you look at the flow, you will see it's almost always the dividend. Now here you have two parts. Here you have two parts: present value of the dividend plus present value of the expected price. Now here again, this is comprised of next dividend and the price, and this price again comprised of the next dividend and the price. So you will see that most part of the price comprises of the dividend. Now in this, so if you take only these two, right, you have a proportion of dividend plus the price. Inside the price again you have a proportion of dividend and the price. In that price also you have a proportion of dividend and the price. So you see that inside the price there is dividend, right? And we take dividend separately also, right? So this can be generalized to say that price is the present value of dividends for an ordinary share. That's what I wanted to emphasize. Get it?
Yes, madam. Now.
Okay. Right. We take value of price of an ordinary share is the present value of the flow of dividends, right? Present value of the flow of dividends. Now, as you are aware, dividend is not predictable, say, dividend is not fixed, like the coupon interest for a bond or any other fixed interest bearing instrument. For ordinary shares, it's the decision of the directors to declare dividend. Whether to declare dividend or not is a decision of the directors, and what should be the proportion of dividend is again a decision of the directors. So we are not sure. We are not sure, like in the case of the bonds, what will be the proportion of dividends that that a shareholder would get, right? So in that case, we try to forecast the dividends, right? Forecast the dividends. And since dividend decision, as the very first, on the very first lesson, I'm sure you learned about 4 types of decisions of a financial manager: investment decision, financing decision, dividend decision, and the working capital management decision. Now, dividend decision is always taken with the intention of maximizing the price of the share. Because if you reserve the earnings without paying a dividend, your financing decision is facilitated because you do not have to go for outside sources of funds if you have your own funds for reinvestment. So in that case, we can say you must reserve what you earn without paying a dividend. Now, the problem is our objective is to maximize the price of the share. So there will be shareholders who are not only interested in capital gains, but also in dividends. And paying a dividend would help increase the price of the share, increase the image of the company and the price of the share. So management should declare a dividend. So it's a trade-off. It's a trade-off between reserving and paying a dividend in order to maximize the price of the share. So normally what happens is dividend, once you decide on a dividend, you continue it for some time. You will not be changing your dividend decision on an annual basis, right? So normally it's a long-term decision. So we can identify certain patterns in the dividend payments. We can identify certain patterns in dividend payments. So sometimes dividends will not grow. The company would pay a fixed dividend for a long time. Say, for example, for 2 rupees dividend will be continued regardless of the proportion of profit, right? It's a decision of the directors. Or there can be dividend. Another company may pay a dividend which will grow every year, right? Dividend will grow at say 5% every year, right? So this year's dividend is 2 rupees, and next year will be 5% more, and the following year will be 5% more on the previous year. Right? So likewise, we may be able to identify a pattern in the dividends, right? Pattern in the dividend. So by identifying a pattern in the dividend flow, we will be able to calculate the present value of the dividend flow for an ordinary share, because price of an ordinary share is the present value of the dividend flow. Okay. Right? So stock value equals the present value of dividends. So this one person suggested, yes, it's the dividend divided by 1 plus. Here it says KS, but it's the discount rate. It's even if you say R, it's okay as long as you know that it's the discount rate, 1 plus R to the power 1. That's the first year's dividend, right? Price today equals the expected cash flows, present value of the expected cash flows. So today's price depends on the future dividend flow, starting from D1, D2, D3 until D to the infinity, because there will be no maturity in the stocks, right? It will flow for the unlimited future. Okay. So this is how we calculate the value of an ordinary share. So in order to facilitate the calculation, we try to observe the patterns in the dividends, so that it will facilitate the calculation, right? So what is a constant growth stock, right? It's ones whose dividends are expected to grow forever at a constant rate G, right? So sometimes, as I told you, there can be companies who would pay a dividend with a constant growth. Every year it will grow at a constant rate. As I said, as example, first dividend is 2 rupees, second will be 5% more, third will be 5% more of the previous dividend. Likewise, dividend will be, it can be considered as one pattern. Right? Yeah. Right. Or a constant growth stock. So we can calculate the dividends, right? D1, next dividend, because we have to start with the future cash flows, right? Since we are not going to talk about dividend already paid. It's not relevant, right? So dividend which is not paid, right? That is D1 is equals to D0, last year's dividend, plus 1 plus G to the power 1. Power 1 is, it's just 1 plus G. So D2 will be either D1 to the power 1 plus G, so multiplied by 1 plus G, or else you can take it as D0 multiplied by 1 plus G to the power 2. Right? So D3 will be d0 into 1 plus g to the power 3, right? So whatever time period, right, dt will be d0 into 1 plus g to the power t. Did you all get that? Get it? Yes. Can I receive? Yes.
Madam, here, why don't we consider D0?
D0 is being already paid. Now say D0 is last year's dividend, isn't it? Here.
Yes, madam. Yes.
Get it?
Yes.
It's already paid. So it's not relevant because price is the expected future cash flows. Take the present value of those, right? So D0 is already being paid. So it doesn't influence the price according to our rule.
So, madam, do we have to assume like that the D0 is already being paid?
But it's last year's dividend. It's now we are here. Today is T0. Today is
Right.
T0, and we are estimating the price P0. So dividend now, say if we stand at January 1st, 2022, right? So it is T0. So we are calculating the price that we are prepared to pay on 1st of January 2022, that is P0, right? So what we receive for the next year is D1. So what is already being paid for 2021 is D0. Understand? So
Yes,
on
madam. Yes.
on D0, we grow at a fixed rate. Okay. Got it.
Clear, madam.
Okay, okay. So this is how you calculate the dividends. So if G is constant, right? If G is constant, if the growth rate is constant only, we use this formula, right? P0 or price today is equals to D0 into 1 plus G, or you can take it as D1, right? You can take this as D1, right? Divided by Ks minus G. Ks is the discount rate minus G is the growth rate of dividends, right? So it is D1 divided by Ks minus G. So we have used this formula when we were talking about a growing annuity, right? We said it's C divided by Ks minus G at that time, I think. So it's the same formula that we use. So we take the next dividend divided by Ks minus G to calculate the price of the share when dividends grow at a constant rate, right? So we will not prove this formula at this stage. You can just take it as given, right? Because our objective is not to prove formulas, but to use them in decision making, right? So what you see here on the red line is the present value of dividends, right? The blue line is the dividend. Now, dividend is growing at a constant rate. Right? Dividend is growing at a constant rate. And present value of dividends is going down, right? It's going down. Why? Now, the further it goes into the time, so if the present value will be less, right? Present value will be less. It's the discount rate. Case is the discount rate. Right? We have already used R. All this time we've been using R. It's the same. Right? Okay. So do you all understand the nature? The dividends will grow. D1 is D0 into 1 plus D to the power 1. So D2 will be D0 into 1 plus D to the power 2. So it will be increasing into the future. But if you take the present value of the dividend, it will be decreasing. And present value of dividend will be decreasing because we are discounting it at the cost of capital or whatever is given. Right? Present value of the dividend flow will decline. And the normal value of dividends in rupee terms will increase into the future at a fixed rate. Right? So if this happens, this formula can be used only if G is greater than, only if K is greater than G. Now, if K is not greater than G, then here there will be a problem here, right? There will be a problem in the denominator of this fraction, right? So only if now if j is greater than k, t0 will be infinity, right? Because this will be a minus figure, right? Okay. Yes, what happens if G is greater than KS? G is growth rate of dividends. KS is the discount rate, right? KS is the discount rate. G is the growth rate in dividends, right? So price equals D1 divided by KS minus G requires that KS is greater than G, right? If KS is less than G, we get negative stock price. So which doesn't give any sense, right? Doesn't give any sense because prices are not negative, right? We can't use model unless K is greater than G. And 2, G is expected to be constant forever. So these are the two assumptions for using this formula, right? Two assumptions for using this formula. One is that K has to be greater than G and G has to be constant. G can't be changing. If G is changing, we will not be able to use this formula, right? Now, this is how to calculate the price of the share if the dividends are increasing at a constant rate. If dividends are increasing at a constant rate, right? So, is it this? Yeah. Then, so how to calculate KS, that is cost of ordinary shares, cost of ordinary shares, right? Cost of KS, cost of ordinary shares. We can use the security market line to calculate. So I'm not sure whether you have learned about SML so far, right? If not, I will just give you only the formula because you will be covering it soon, right? You will
Madam,
be
you are not audible.
Sorry?
Your voice is breaking, madam, sometimes.
Okay. Do you want me to repeat what I said?
No, madam, that SML thing.
Okay, okay. Yeah, SML, SML is a security market line, right? This is used to calculate the cost of the share, right? Cost of share, right? KS. So you will learn about SML when you talk about risk and return, right? This topic is taken by Dr. Anuradha, right? So I'm not going to talk about it now, but I will tell you only the formula, right? Only the formula. Sorry. Yes. So this is the formula. K is cost of ordinary shares equals the risk-free rate plus the risk premium. This is the market rate minus the risk-free rate. So this gives the risk premium. Within brackets, it gives you the risk premium multiplied by beta of the firm's beta that we are talking about, right? Firm's beta. So I will give you only the figures for the moment. So once you cover the lecture, you will understand what it is, right? So this is a way of calculating the cost of ordinary shares.
Excuse me, madam.
Yes. Yes.
You're not audible, madam. We can't hear you.
Oh, really? Yeah, I will. My internet seems to be okay, and I'm using the this thing also, but I will try to talk a little louder again. Okay, so yes. So we are trying to calculate the cost of ordinary shares by using the securities market line. So about securities market line, you will learn in one of the next 1 or 2 lessons, right? So my lessons will be over from today and Dr. Anuradha will take over from next week. So she will be covering this area, right? So we will say for the time being, we will learn how to just put the figures and calculate cost of ordinary shares, right? So normally it's given for our purpose, but I'm just mentioning that there is a way of calculating also, right? Assume beta, firm's beta is equals to 1.2. KRF is the risk-free rate right? You know what is risk-free rate, right? That is what you get as time value, right? What you get as time value. That is 7%. And market rate for the general market rate is 12%, right? What is the required rate of return on the firm's stock, right? Required rate of return is used as the discount rate. Okay, can you all hear me now?
Yes, madam.
Okay, okay, thank you very much, right? So we will try to calculate using this information. We will try to calculate the cost of the ordinary shares, right? So the formula is KS, cost of ordinary shares, equals the risk-free rate plus the risk premium into beta of the firm, right? Risk-free rate is 7%. Market rate, that is the return for the market portfolio, 12% minus risk-free rate is 7%, multiplied by firm's beta 1.2, right, gives you 13% as cost of ordinary shares. So this is a way of calculating the cost of ordinary shares, right? So we take it, and then now we are going to an example. D0 was 2 and G is a constant 6%. Find the expected dividends for the next 3 years and the present values. KS, or the cost of discount rate. Yes, yes. Expected return of the market portfolio is now in what I didn't want to step into this discussion because it's a very time-consuming explanation, right? It's a very time-consuming explanation, but I will just mention as answer to your questions. What is market KM is, say for example, if you have a portfolio consisting of all the assets, all the shares in the market. If you have a portfolio consisting of all the assets in the market, and the return that you get for that portfolio is called the return on the market portfolio, KM, right? This, right? Now beta is, now the beta of the firm is, now you can observe that the individual shares prices will change, right? So or returns for the individual assets would change according to the changes in the market. So if the market goes up, maybe the firm's returns go up. Market goes down, firm's return may go down, right? So more or less it will follow the market, right? But the degree of the change according to the change in the market will be different from firm to firm, right? So that is indicated by beta. Now beta 1 is the market beta. If beta is equals to 1 is market beta, because market portfolio changes with the market 100%, right? Now this 1.2 means when the market is changing at 1, this firm's returns are changing at a higher rate of 1.2. Right? Say for example, beta is less than 1, that is 0.8. It means that when market changes at 1, the firm's returns are changing at a lower rate than the market rate, right? Okay, I hope I could answer that question as we are like using the least words as possible, right? Because it's not my topic. I shouldn't be like say, yeah, let's see. Okay, okay, right, yeah. So we
Madam,
move on. Yeah. Yes,
can you give us a brief example of KRF as well?
KRF is the risk-free rate. That is, say normally we take the short-term government securities rate as the risk-free rate. Short-term government securities, 3-month security bill rate, we take as the risk-free rate because we believe that the default risk is minimum. Because the government will never, the central bank will never default the payment, right? And it's short-term. So we believe that, yes, because default risk is not there and it's short-term, we believe that the return is for the time value. We normally take it as the securities, government securities rate.
Thank you, madam.
Okay. Right. So we move on to the calculation. Right. Now we are trying to calculate the price of a share where dividends grow at a constant rate of 6%. Right. So D0, the previous dividend paid was 2, and G is at a constant 6%. So it grows at a constant rate of 6%. Find the expected dividends for the next 3 years, right? And their present values. So the discount rate or the cost of capital is 13%. So shall we give it a try, please? Shall we give it a try? Last dividend was 2, which is already being paid. And it will grow at a constant rate of 6% forever, right? But we are supposed to find dividends for the next 3 years. Next 3 years. And their present values, right? The discount rate is 13%. So shall we do that calculation quickly? Thank you very much for the answers. Thank you very much for the answers. So let's check the answers. Yes, let's check the answers. Yes, let's check the answers. Yeah. Yes. D0 was 2, right? At time 0, D0 was 2. So the next cash flow is 2 rupees should grow by 6%, which gives you 2 and 12 cents. And that should grow again by another 6%. That will give you 2 and 24 cents, right? And that will also grow by 6%, which will give you 2 and 38 cents, right? So you have to discount this now. We are supposed to calculate only 3 years, right? 3 years. And we are supposed to calculate the present values also, given the cost is 13%. So 2 and 12 cents has to be discounted at 13% for 1 year. That is 2 and 12, 2.12 divided by 1.13. Right, then the second one has to be 2 and 24 cents has to be discounted for 2 years. That is 2 and 24 divided by 1.13 to the power 2. 3 we 2.38 has to be discounted at 13% for 3 years. That is 2.38 divided by 1.13 to the power 2. So you get 1.8761 as the present value of the first dividend, 1.7599 as the present value of the second dividend, and 1.6509 as the present value of the third dividend, right? So if you add these three together, you get the present values of these three dividends, right? I think everybody could understand that, right? And we can find the price. What's the stock's market value or what's the stock's price, right? D0 is 2, KS is 13%, right? And G is equals to 6. So if we use the constant growth model, that we just learned, that is D1 divided by KS minus G, right? D0 is 2, D1 is how much? D1 is 2 and 12 cents, right? 2 and 12 cents divided by 0.13 minus 0.06, right? How much will be the price? How much will be the price? How much will be the price? Yes. 2 and 12 cents divided by 0.13 minus 0.06 will give you how much? Yes. Can anyone give me the answer, please? Yes, I have 3 answers, all the same. So it implies that it can be the correct answer. Thank you very much. Right, thank you very much. So let's check the answer. Let's check the answer. So it's 2 and 12 cents divided by 0.13 minus 0.06 will give you 30.29, right? 30 rupees or $30.29. 212 divided by 13 minus 6 is 7. So you divide it by 0.07, you get 30.29, right? I hope everyone got that answer, right? So this is the price that the anyone who purchases is prepared to pay for this share, right? Prepared to pay for this share. Then what is the stock's market value from 1 year from now? What is the stock's market value 1 year from now, right? Right? So P1, if you take P0, you take D1 divided by KS minus G. Now, if you take P1, it has to be the next dividend because P1 is price of end of year 1. So price of end of year 1, by that time, D1 is already being paid. Right? D1 is already being paid and it will not be considered as a cash flow. Right? So you take D2. If it is P1, you take D2. D2 divided by KS minus G. Right? KS minus G. D2 divided by KS minus G. So we have to calculate. I think we have already calculated D2. Right? We have already calculated D2. That is 2.24. Right? 2.24 divided by KS minus G. 2.24 divided by 0.13 minus 0.06. Right? 0.13 minus 0.06. And we can also find P1 by multiplying P0 by 0.06. Right? Right. P0 into 1.06, right? P0 into, because dividend is growing at 0.06, right? So we believe that the price will be growing at 1.06, right? So we can calculate or we can check the answer, right? Yes. Check the answer. Yes, check the answer. The D1 will have been paid. So expected dividends are D2, D3, D4, and so on. Thus, we take T1, expected price of T1 is equals to D2 divided by Ks minus G. D2 is 2.247, right? 0.13 minus 0.06, right? So when you simplify, you get 32 and 10 cents, right? And it's the same if you take P0, which was 30 and 29 cents, increase it by 0.06. 1.06 will give you the same price, right? 1.06 will give you the same price, okay? Then find the expected dividend yield, capital gains yield, and total return during the first year. So when we were talking about the returns from an ordinary share, we said there are two types of returns. One is in terms of dividends, and the other is in terms of capital gain, right? Capital gain. So dividend yield is calculated as D1 divided by P0, right? What you would receive as dividend divided by the price that you are prepared to pay, right? D1 divided by P0. And the capital gains yield is the difference in prices. Difference in prices, that is P1, expected price at P1 minus P0 divided by P0. Right? So total return will be the addition of these two, right? So it will be the addition of these two. Total return comprises of the dividend yield and the capital gain yield, right? Total return comprises of the dividend yield and the capital gain yield. Find the expected dividend yield, capital gains yield, and the total return during the first year, right? Total returns during the first year. So let's take the first year. So since we are taking the first year, we will take the price as P0, right? So D1 divided by P0 will give you the dividend yield. D1 divided by P0 will give you the dividend yield. 2 and 12 cents divided by 30.29 will give you 7%. So dividend yield is 7%, right? Then capital gain yield. Capital gains yield is expected price P1 minus P0 divided by P0. So we have already calculated P1. We have already calculated P1 as 32 and 10 cents. 32 and 10 cents, right? So we calculated it as 32 and 10 cents, right? 32 and 10 cents. So that minus 30 and 29 is P0. That also we calculated. 32 minus, 32.10 minus 30.29 divided by P0. Again, divided by 30.29. So you get 6%. 6% as capital gains yield. And you see that it's the same as the dividend growth rate, right? It's the same as the constant rate of growth in dividends, right? Capital gains yield. So total return is the total of these two, dividend yield plus the capital gains yield, which gives you 13%. As dividend yield is 7%, capital gains yield is 6%, and you get 13% as total return. 13% as total return, right? Right, total return. Okay, 13%. Then you can find, now all this time we were estimating the price using the other information given. So you can find the price like Ks, right, by rearranging the model. rearranging the model. If you know the dividend, if you know the price, and if you know the growth rate in dividends, you can find the rate of return, right? Another way of finding the rate of return is this, right? Rate of return. So when you say P0 equals D1 divided by Ks minus G is the formula that we use to assess the price or estimate the price of an ordinary share. So you can solve it for Ks, right? So expected Ks is equals to D1 divided by P0 plus G. D1 divided by P0 plus G, right? So you can find the cost of the rate of return when the other information is given, right? When the other information is given. Okay. So we can calculate Ks and C, right? Ks and C. D1 is 2 and 12 cents. D1 is 2 and 12 cents divided by P0, which is 30 and 29 cents. 30 and 29 cents plus G is 6%, 0.06, right? So it gives you 13%, right? 0.07 plus 0.06 will give you 0.13, which is expressed as a percentage will be 13%, right? So what would be P0 if G is 0, right? What now? First option or the first pattern of dividends that we considered was that dividends would grow at a constant rate, right? Dividends would grow at a constant rate. And we learned that to calculate the value of the share when the dividends grow at a constant rate is we use P0 equals D1 divided by Ks minus G to calculate or estimate the price of an ordinary share when dividends grow at a constant rate, right? And now what happens if the dividends grow at 0 rate or G is equal to 0? Or in other words, what happens if the firm pays a constant dividend? The firm pays a constant dividend. That is, if you pay 2 rupees this year, they will continue paying 2 rupees forever as dividends, right? Or for a long time as dividends, right? Then what happens if you receive the same amount of money periodically for a long time period into the future? You consider it as a perpetuity. You consider it as a perpetuity, right? Perpetuity is present value is found as perpetuity, the periodic payment divided by the interest rate. Periodic payment divided by the interest rate. So present value of this perpetuity is considered as the price of the ordinary share, right? Present value of the perpetuity is considered as the price of the share. So P0 expected price is equals to the payment or the periodic payment divided by the discount rate, right? Periodic payment divided by the discount rate. So you can calculate the value. Periodic payment is 2 rupees because no growth or G is equal to 0 implies that the company is paying a constant dividend, right? 2 divided by 0.13. 2 divided by 0.13 will give you the price of a share, right? 2 divided by 0.13 will give you the price of a share, right? Okay, 2 divided by 0.13. 2 divided by 0.13 will give you 15 and 0.38. 15.38. 15.38 is the price of the share if the dividends are constant or the dividend growth rate is 0, right? If the dividends paid by a company are constant or the dividend growth rate is 0. Okay. Yes. Right? Did everyone understand up to that point? So if you try to find the price of a share 1 year from now, then you consider two cash flows, right? So constant dividend is 2, and at what price would you sell at the end of year 1, right? And you take the present value of these two items as price. Understand? Get it? Yeah, so your question is, if dividends are a perpetuity, how to find the price of the share 1 year from now? Now, your idea is, right, say, how to find the price of the share 1 year from now. So from that date at P1, right, so it will be P1, at P1, it will be the flow of dividends, right, flow of dividends. So present value of the flow of dividends, right? If you are thinking of, say, for example, if you are thinking of selling the share at P1, right? It will be like in the earlier case, it will be the dividends, 2 rupees plus the present value of the price. But if you want to, like, say, go 1 year ahead and then calculate the price, it will be from that point, it will be the perpetuity, right? It will be the value of the perpetuity, right? Normally, in the case of perpetuities, after some time now, perpetuity is a cash flow that will go into infinity. So when you bring them to the present, right? When you bring them to the present, the farthest ones will be zero, will be near zero, right? Because 2 rupees discounted for 200 years at 10%. Imagine the value, right? There will be only a small difference, right? Because 1 year less from infinity will not make much of a difference. Get it? Get it? Okay, thank you very much. Right. So now these the two patterns that we observe. Sorry?
Yes. Excuse me, madam. So
Yeah.
does that mean the price is same at P0 and P1 as well?
Could be, no? Because doesn't mean it's same, but the change may be negligible.
Okay, madam. Thank you. And could you kindly go to slide 19 also, madam?
Yeah.
Sorry, not 19, 21.
Yeah. Yes.
Uh,
Is it
no,
this?
the next one.
The calculation.
23. Yeah, yeah.
Yeah. Okay. 22. Yeah.
23.
Is it this? 23.
Next one. So in that
Okay.
case, the required rate of return is D1 divided by P0 plus G.
Yeah.
So basically, that means that is dividend yield plus growth rate, isn't it? So,
Yes. Yes.
and
So it's the required rate of return, right?
yes,
Yeah.
madam. So the numbers are quite similar. So are there any relationship between that 13% and what we calculated using SML and all? Because numbers are quite similar and all.
It has to be like, say, at equilibrium. Now, SML comes from the side of the investor. For any investor thinking of purchasing a share, this can be, the return can be calculated using the SML formula. Right? Now, this is our calculation of, say, from the side of the firm, right? This is our calculation. Is how to calculate using this is called Gordon model or the dividend growth model, right? So estimated dividend divided by P0 plus G is the rate of return. I don't know. I don't know whether I could communicate it properly to you.
Yes, madam. So earlier it is from the view of the investor, and here it's point of No. Is it from the investor?
Is
From
now
perspective.
yes, it's another like say this is a model, right? That is another model. SML is another model. This is another model, right? So if we put, yeah, it's confusing because the rates are the same, right? That's the problem. No?
Yes, madam, that's what.
So I wanted to show you this can be calculated using SML also, because SML also talks about the cost of an ordinary share, or the return, or the expected return of an ordinary share. Right. So at any point in time, if you are talking about an investment, right, the particular investment, you have to know the particular investment beta, and then market rate, and then you can assess the rate of return for that investment, right? Now this is a model. This model is is um, is used when the dividend growth is constant only. Now, if G is changing, we can't be estimating the price based on this model, right? So it's another way, or it's I don't know how to tell you. I just like I don't know whether I don't know how to put it. Right. Now, SML can be used by any investor on any individual asset or a portfolio to calculate the return, right? So about it, you will be learning a lot more in the lessons to come, right? Now, this model can be used to estimate the price only if the dividends would grow at a constant rate. So there is a limitation in that, in this, the usage of this model. So in this condition, under these conditions, if we want to calculate the cost of shares, we can use that one, D1, sorry, P0, P1 divided by P0. This, where is it? Slide that was 23, was it? Right. So this is possible only when G is constant. This is possible only when G is constant. Okay. No.
Yes, madam, clear. Thank you.
Okay. Right. Where were we? We were at the we were here. You know, we finished that with zero growth. Yeah, it's not that. It's yeah, we were here, right? So far we have identified two patterns of dividends, right? We have identified two patterns of dividends. One is that the dividend would grow at a constant rate G, right? Dividend would grow at a constant rate. The second is that dividend would not grow, or at zero growth, or a constant dividend, right? And now in between, there can be instances where firms would change the dividend policy for a short time period, right? For a short time period. Say, for example, if a company could come out with some, say, cost reducing method due to an investment in research and development. So they have the patents or the rights for some time. So during that time period, this company would increase their earnings. Their company's earnings would increase because they have found something, a new invention, right? So for a short time period, they may be enjoying high earnings because when time passes, the other companies would copy the technology, and then these earnings would be diluted, right? So for some time period, companies may enjoy high earning periods, right? So you call it supernormal growth, right? But that will not there will be there forever, because others in the industry would copy the technology and then the profits would be diluted. But for a short time period, the company would be earning high earnings, and the company would want to reward the shareholders with their high earnings. So they may declare a higher dividend only for a short time period, right? So if we have supernormal growth of 30% for 3 years, then a long run constant growth rate of 6%, right? So for a short time period, they will pay 30% dividend, right? And then after that, from the 4th year, they will fall into the long run constant rate, growth rate of 6% in dividends. So in that case, what is the price today, right? If K is still 13% and D0 is 2, right? So last dividend paid was 2 and the cost of capital is 13%. And what will be P0 if the company pays 30% of dividend of the previous dividend, right? For 3 years, and then it falls into a constant rate of 6%, right? Now, in this case, you see that you cannot use the usual constant growth model. So we cannot use the constant growth model, because in the constant growth model, we specify that growth G has to be constant right throughout, right? Which does not apply here, which does not, is not in compliance with the description given, because it says 30% growth will be observed for the first 3 years. So however, growth becomes constant after 3 years. So after 3 years, we will be able to find since we are falling to a constant growth, we will be able to find the present value of the dividend flow using the constant growth model, right? Okay. Right. Then let's see how we can calculate the price. Now, what we would do is we will calculate by hand the dividends for the first 3 years. Now, going by the definition, price of a share or price of any cash flow generating asset is the present value of the cash flows generated by that asset, right? So we should cover all the cash flows that are generated by the asset, and add those together to call it the price, right? So for the first 3 years, let us calculate the dividends by hand. Let us calculate the dividends by hand. Now we know D0 and we can calculate D1, D2, D3, right? And then from the 4th year, right? From the 4th year, it falls into a constant rate of 6%. And from that point to the future, to the infinite future, there will be dividends growing at 6%. So we can calculate the present value of that flow at the end of year 3, right? And can convert it into the present value and add to the the dividends of the first 3 years, present value of the dividends of the first 3 years, right? Did you all get it? Or do you want to give it a try? Just give it a try and see. Yes, we are trying now. Our objective is to estimate the price. Price is the present value of the dividend flow, right? So first 3 dividends are separately taken, calculated, and converted to the present value. From the 4th year onwards, it falls into a constant rate. So if you calculate that value at the end of the 3rd year, you get the value of all the future dividends at the end of the 3rd year. So that figure can be converted to today's value to be added to the other dividend flows, right? So can you give it a try? Okay, shall we? Yes, I'm got one person's response. Yeah. So D is non-constant growth followed by constant growth, right? So D0 is the previous dividend was 2 rupees. And growth of 30% in dividends can be observed during the first 3 years. So 2 into 1.30 to the power 1 will give you 2 and 60 cents, right? It's the first year's dividend. And then it will grow another by another 30% in the next year, right? So 2.6 into 1.30 to the power 1 will give you the second year's dividend, right? Is 3 and 38 cents. So it will grow again by another 30% for the third year. It's 3.38 to the power 1.30 to the power yes 1. Right? So it will give you 4.394. Okay, and after that it will fall into a growth rate of 6%. So year 4 dividend will be 4.394 to the multiplied by 1.06, which is 4.658, right? Understand? I hope it is clear for you. So 2.6 has to be discounted at 13% for 1 year. It will be 2.301. And the second year's dividend, 3.38, has to be discounted for 2 years. That is 3.380 divided by 1.13 to the power 2. It will give you 2.647. And year 3 dividend, 4.394, has to be discounted for 3 years at 13%, which is 4.394 divided by 1.13 to the power 3 will be 3.045, right? These are the present values of the dividends for the first 3 years. And from the 4th year onwards, it will fall into a constant rate of 6% forever, right? So until infinity. So we will calculate the value at end of year 3. Now starting from year 4, it falls into a constant rate, right? So if you apply this constant rate formula, you will be applying it at this point, at end of year 3. At end of year 3, if you stand here at end of year 3, you see a constant growth modeling, constant growth behavior in dividends, right? So what we can do is at this point, at the end of year 3, we can calculate the value of the dividends of this model, right, of this behavior, of this pattern, where the dividends would grow at 6% forever, right? So for that, right, that is end of P3, right? It's P3. Now, end of year, here this is end of year P3. So it will be P3. If we stand here and calculate the price, it will be the next dividend, right? P3 will be next dividend, that is year 4 dividend, D4. We have already calculated 4.658 divided by 0.13 minus 0.06. Now, growth rate is 6%. Discount rate is 13%. So the value that we receive is for end of year 3, right? That is 66.54 at end of year 3. We have to discount this for 3 years as a single sum of money for us to convert it into today's value. So 66.54 has to be divided by 1.13 to the power 3. 1.13 to the power 3, right? 1.13 to the power 3, which will be 46.114, right? So when you add these 4 figures, you have considered all the dividends until infinity, right? You have considered all the dividends until infinity, right? So you add those together, you get 54.107, 54.107, right? So the person who has given the answer, this answer, it is correct. Yeah.
Madam, excuse me.
Yeah.
Why can't we take the power as 4?
Where
In-
power?
the
At
last
which
one?
point? Yeah, this
The
one.
last
This,
one.
66.54.
Yes, 66.54 divided by 1.13 to the power 3.
Yeah, because the value we set the end of year 3. So we have to discount only for this period. Now, if it was here, 0.4, right? Then we will discount it for 4 years. But now see P0, if you take P0, take P1 divided by Ks minus G. Now you are here, at end of year 3, at the same time, it's the beginning of year 4. End of year 3 and beginning of year 4, right? Year 4 will give you a growth rate of 6%. So this is the relevant growth rate, right? Divided by Ks minus G, right? So this again, now here we are here, if you forget about this, so this is like P0. If you think that it's the start, it's like P0. So you take next dividend divided by K minus G, right? So here, if you take, this is like beginning of year 4, and it's at the same time, it's end of year 3. So you are just 3 years away from today. 3 years away from today. Because the price that you calculate is relevant for end of year 3 as well as beginning of year 4. Understand?
Yes, madam.
Okay. So are we going to take a break today? Yes. Are we too? Last week, of course, the electricity board gave us a break. Yeah. Are we to take a break?
Yes, madam.
Okay. Okay. Then we'll meet up at 10:30. Okay. Hello. Hello. I think as it's 10:31, right? So I think we can start now. Yes, this is the place where we were. So we could calculate the price as 54 and 10 cents, right? 10 cents. Okay. And then we move on to what is the expected dividend yield and capital gains yield at t equals 0 and at t equals 4, right? So dividend yield and capital gains yield. Dividend yield and the capital gains. Yes. Yeah. Dividend yield. Dividend was, I think this. Yeah. Yeah. So what is the expected dividend yield and the capital gains at t equals 0? So if you are at t equals 0, then you take D1. D1 is 260 divided by price, right? 260 divided by price will give you 4.81, right? If you are at t equals 0, you take the next dividend, that is 260 divided by the price will give you the dividend yield. Right? And then capital gains yield. Now we have the total return as 13%, right? Required rate of return is 13%. So 13% minus the dividend yield. Now total return equals dividend yield plus the capital gain yield. Now do we know the total return or the total yield plus the dividend yield? So if we take the difference, it will give us the capital gain yield. 13% minus 4.81% will give us 8.19 as capital gain yield, right? Now, during the non-constant growth, dividend yield and capital gain yields are not constant, right? And capital gain yield is not equal to G. In the non-constant growth, dividend yield and the capital gain yields are not constant, and capital gains yield is not equal to G. Earlier we saw that the capital gain yield was equal to the dividend growth rate. Was equal to the dividend growth rate. In that example, it was 6%, right? So after t equals 3, G is constant at 6%, right? After year 3, G becomes constant at 6%. So capital gain yield equals 13% minus 6% equals 7%. So capital gain yield becomes 7% after T3, right? After T3, that is from T4 onwards, capital gain yield becomes 7%. Before that, it was 8.19%. So if the dividend growth rates are non-constant, right? Non-constant, then the capital gain yield is not equal to the dividend growth rate, right? Suppose G is equals to 0 for T1 to T3, and then G is a constant 6%. What is the price today of the share? Suppose G is equals to 0, which means the dividend would not grow, but the company would pay a constant dividend between year 1 and year 3, right? And then G is a constant 6%. How shall we calculate the price? How shall we calculate the price? So I will explain it. Suppose G is equals to 0 for T1 to T3, which means D0 will remain for another 3 years. So the dividend in year 1 will be 2, dividend in year 2 will be 2, and dividend in year 3 will be 2. right? So will be 2. So all what we can do is, and from year 4 onwards, it will start growing at 6%, right? So in year 4, dividend will be 2.12, right? So we have to take the present value of all the dividends, right? Present value of all the dividends. So let's discount the first 3 dividends. Year 1 discounted at for 1 year. 2 divided by 1.13 to the power 1 will give you 1.77. In year 2, 2 divided by 1.13 to the power 2, you will get 1.57. In year 3, 2 divided by 1.13 to the power 3, you will get 1.39. So these are the present value of the dividends for the first 3 years. And then from year 4 onwards, it falls into a constant growth rate of 6%. So we take the next dividend at P3, expected price at end of P3, you get the next dividend is 2 and 12 cents divided by the difference, right? 13% minus 6% will give you 7, right? Divided by 0.07 equals 30.29. And 30.29 has to be discounted at 13% for 3 years. 30.29 divided by 1.13 to the power 3 will give you 20.99. So once you add all those dividends together, you get 25.72 as the price, right? Price of a share if the dividends do not grow for the first 3 years and then start growing at 6% per year forever, right? Then what is the dividend yield and capital gains yield at T0 and at T3, right? Yes, at T0, we have D1 divided by P0. D1 is 2 divided by the price, 25.72, will give you 7.78, right? 7.78 as the dividend yield. Then the capital gain yield will be the total return minus the dividend yield. The total return is 13% minus 7.78 will give you 5.22 as the capital gain yield at T0, right? In T3, now we have constant growth with G equals capital gains and 6 equals dividend yield, right? Price at T3. Price at T3 here. You are referring to this? You are referring to this? Now we price at T3 is the, price at T3 is the only difference is we have not written the formula here. So if you go back here, see, it's the same way. P3 is D1 divided by KS minus G. The next dividend at whatever point, if there is constant growth, it's the next dividend divided by KS minus G, right? It's the same that we have done here also. Only difference is what we have done is 13 minus 6 is 7. We have just put 7 here. It's the next dividend. Now, dividends are constant. Our growth rate is 0 for the first 3 years, and then they start growing at 6%. So the year 4 dividend will be not 2, but increased by 6%, 2.12. So if we are calculating the price at end of year 3, then we have to take D4. If we are calculating it at P0, we will always take D1, right? Not in this case, right? If it is a constant growth, right? So we take D4. D4 is 2 into 1.06. 2 into right? Right? So you get 2 next dividend divided by KS minus G. 212, right? 2.12 divided by 0.07, you get 30.29. So 30.29 should be brought to today's value, because we will take the present value of the dividend flow, right? Present value of the dividend flow. So we have to convert it into today's value. To convert it into today's value, we have to discount it for 3 years. We have to discount it for 3 years. So when we discount it for 3 years, we get 20.99, right? 20.99. 20.99. So we add that. This is the present value of all the dividends starting from year 4, right? Starting from year 4. Then you add the present values of the first 3 years dividends, you get 25.72, right? I hope I could answer your question. Yes. No, you are wrong. Okay, that means price of stock at T3 is equal to 20.99 is right. No, it's wrong. It's the present value, right? Price is 30.29. Did you get it? Yes, did you get it? Okay, thank you very much. Right? Then, what is dividend yield and capital gains yield at T equals 0 and T equals 3? Right? So, at T equals 0, dividend doesn't change. D1 is 2 and you divide it by P0, which is 25.72. The answer is, or the dividend yield is 7.78%. 7.78%. So the capital gain yield is the difference. Is the difference between 13% minus 7.78 equals 5.22. Right? 5.22%. Right? From at year 3, you have constant growth with G equals capital gains yield. We notice that if there is a constant growth in the dividend, capital gain yield equals the dividend growth rate. Right? So at T3, we can easily take the capital gain yield as 6% or the growth in dividends, right? And the dividend yield will be 7% because the total yield is 13%. Okay. Now, if G is equals to -6, minus growth in dividends, negative growth in dividends, would anyone buy the stock? If so, at what price? Right? So, yes, if growth is negative, would anyone buy the stock? If so, at what price? So, although the growth in dividends is negative, right? The growth is negative, that is declining, but there is still a dividend being paid, right? Lesser dividend every year, right? So price has to be positive. Okay, so price has to be positive. So since it's constant decline of 6%, constant decline of 6%, we can, since it's a constant decline, we can use the this formula, P0 equals D1 divided by Ks minus G. Right? D1 is D0 into 1 plus G. Right? Now, if we take the negative growth, now D0 is 2. Negative growth is 1. Now, it's not plus. 1 minus 0.06. Right? It becomes 0.94. So 2 multiplied by 0.94 divided by 13 minus 6. Isn't it? Right? So 2 into 0.94 divided by 13 minus 6 minus 6. So it becomes 0.19. Right? So the numerator becomes 1.88 divided by the denominator becomes 1.19 or 19%. So the final answer, the price is 9.89 or 9 rupees and 89 cents. Okay. If there is a negative growth, if there is a negative growth. WCV Pereira, your microphone is on. Yes, can you please mute it? Okay, so minus 6 became 19 and 9.89 is the price, right? So there can be negative growth in dividends also. Now, what is the annual dividend yield and the capital gains yield? Right. So capital gain yield is the constant growth equals minus 6. Right. Capital gain yield is a negative 6%. Dividend yield is now the difference between the total return yield and the capital gain yield. So 13% is the total return or the total yield minus 6 is the capital gain yield, right? So 19% is the dividend yield. 19% is the dividend yield. So dividend yield and capital yield are constant with high dividend yield offsetting negative capital gains yield, right? Then, yeah. So then that brings us to the end of the dividend growth model. So in this model, what we believed was the according to our common valuation model, it's the value of so price of an asset is the present value of the cash flows that asset would generate. So in the case of an ordinary share, we believe that the dividend flow dominates, right? Dividend flow dominates, and the price of the share depends on the present value of the dividend flow. So we have looked into different patterns of dividends that can occur in firms. So there can be a constant dividend with zero growth. There can be constant growth in dividends, that is forever it will increase by a constant rate. And the third option is that there will be supernormal growth for some time period and then it falls into a constant growth, right? So we have considered all that possibilities and learned how to calculate the price of a share, right? And now we move on to the free cash flow method. So at the very beginning, I mentioned that there are 3 models to value ordinary shares. One is the dividend growth model. Second is the free cash model. The third is taking some ratios, right? Taking some ratios and trying to forecast the price, right? So we have now come to the second one, free cash flow method. So let's look at what is a free cash flow. The free cash flow method suggests that the value of the entire firm equals the present value of the firm's free cash flows calculated on an after-tax basis, right? Free cash flow method suggests that value of the entire firm equals the present value of the firm's free cash flows, right? So we should be able to calculate the firm's free cash flows to calculate the present value to call it the value of the firm. So recall that the free cash flow in any given year can be calculated as net operating profit after tax minus net capital investment, right? Net operating profit after tax minus net capital investment gives us the free cash flow. Free cash flow, right? Gives us the free cash flow, right? Once the value of the firm is estimated, an estimate of the stock price can be found as follows. So once you take the present value of all the free cash flows, you get the value of the firm, right? Value of the firm. So what you can do is take the market value of the firm and extract from it market value of debt and preferred stock, right? So once you get the market value of the firm using the free cash flows, you deduct from that market value of debt and preferred stock. So what is remaining is the market value of common stock or the value of common stock. So when you have the value of common stock, you can divide it by the number of ordinary shares. You can divide it by the number of ordinary shares so that you can get price of one share, right? Estimate of a price of one share. Okay. So issues regarding the free cash flow method. Free cash flow method is often preferred to the dividend growth model, particularly for the large number of companies that don't pay a dividend or for whom it is hard to forecast dividends, right? So dividend growth model wants us to forecast the dividend for the future. So forecasting has to be accurate. And the other thing is there are companies who do not pay a dividend. So if there are many companies who do not pay dividends, they cannot use this dividend growth model in pricing shares. So that is an issue. Then for that, similar to the dividend growth model, the free cash flow method generally assumes that at some point in time, the growth rate in free cash flow will become constant, right? So in the dividend growth model, we believe that at one point in time, it will fall into a constant growth model. So similarly, in the free cash flow method also, it is believed that some point in time, the growth rate in free cash flow will become constant, right? It will fall into a constant growth pattern. So terminal value represents the value of the firm at the point in which growth becomes constant, right? Terminal value is the value of the firm at the point in which the growth becomes constant, right? So we have an example, right? Free cash flow estimates for the next 3 years are 5, -5, 10, and 20 million, after which the free cash flow is expected to grow at 6%. The overall firm cost of capital is 10%, right? Is 10%. So let's look at the present value. Now in the free cash flow method, they say it's the value of the firm is the present value of all the free cash flows. So first year you get a -5 million, second year you get a positive 10 million, third year you get 20 million, and then after that it will fall into a constant growth of 6%, right? So since we need to calculate the present values, the discount rate is 10%. So 5 discounted for 1 year, 5 divided by 1.10 will give you -4.545. Now for the second one, the 10 million free cash flow in the second year has to be discounted for 2 years. That is 10 divided by 1.10 to the power 2. You get a present value of 8.264 for that. Then in the third year, you get 20 million. You get 20 million and 20 million, and you have to discount it for 3 years. That is 20 divided by 1.10 to the power 3, and you get a value of 15.026, right? And then from that point onwards, growth will be constant at 6%, right? 6%. So we calculate the current or the next cash flow, free cash flow at a constant 6% rate, growth rate. 20 into 1.06 will be 21.20, right? 21.20 divided by Ks minus G. Ks is 10%, G is 6%. So you get 4%, right? 21.20 divided by 0.04, you get 530. You get 530. So the value of the free cash flow at the point that the firm falls into a constant rate is called the terminal value, right? Terminal value. So terminal value happens at the end of year 3. So we have to discount it at 10% for 3 years. Discount it at 10% for 3 years. That is 530 divided by 1.10 to the power 3. The answer is 398 and 0.197. right? So when you add all these together, you get the present value of all the free cash flows or value of the firm, right? Value of the firm. We call it the value of the firm, right? So if the firm has 40 million in debt and 10 million shares of stock, what is the price per share? So value of equity equals the total value in terms of the present value of free cash flows minus value of debt and preferred stock, right? So total value that we have calculated as the free cash flow or the present value of free cash flow or the value of the firm is 416.942 million, right? That minus 40 for debt and 10 for preferred stock, right? Sorry, it's not, it's debt only, 10 million shares, not preferred stock. Yes, total value minus 40, that is firm's value of debt. So 416.94 minus 40, we get 376.94 million as value of equity. Now, value of equity, if we divide it by 10 million shares, if we divide it by 10 million shares, $10 million shares, you get the value of a share, 37.69, right? 37.69. Okay, so that is how you use in very brief terms how you use free cash flow. Right? So net capital investment for that year, right? That is net capital investment for that year, right? Then, yeah. Then the other third type of calculation using the multiples of comparable firms to estimate stock price, right? Analysts often use the following multiples to value stock. Price to price, this is price earning, right? Then price to cash flow, price to sales, price to customer, right? Example, based on comparable firms, estimate the appropriate PE. Multiply this by expected earnings to work out an estimate of the stock price. Now, what we do is say, for example, if we take one of these, right? Say price earning ratio, that is price divided by earnings per share, right? Price earning ratio is market price divided by earnings per share. Then you will get an answer, right? You will get an answer. So what you can do is you can take, now normally price earning ratios are calculated by the stock exchange and published on individual basis, a firm basis, industry basis, and overall basis, right? So you can choose a PE ratio as a benchmark. Say, for example, PE for the industry in which this particular firm operates, right? So you have this figure equals price divided by earnings per share. So you can calculate earnings per share by using the financial statements. And then you have the PE ratio multiplied by the earnings per share, you end up getting the price. That's a forecast of the price. So although there are many methods like say dividend growth model and the free cash flow method for forecasting share prices, most commonly used one is this multiple, right? PE multiple is very common among investors because it's easy to calculate and yes, it's easy to calculate and data is freely available and simply due to its simplicity, any person can calculate using it, right? So what is market equilibrium? What is market equilibrium? In equilibrium, stock prices are stable, right? there is no general tendency for people to buy versus to sell. So at equilibrium, prices are stable, so that there will not be buying and selling taking place for correcting the price, right? So in equilibrium, expected returns must equal the required returns. Expected returns must equal the required returns. Now, required return by the investor, the person who spends money on buying the shares. He has his own valuation. He would want there'll be a required rate of return for the investor, right? So as I said, SML or the CAPM is used to calculate the required rate of return of a particular security or a portfolio by any investor, right? And on the other hand, expected returns are related to the firm's expectation, right? Firm's expectation of the returns, right? Now, when these two balances or when these two becomes the same, you say that there is market equilibrium, right? Market equilibrium. So expected returns, that is K at S equals D1 divided by P0 plus G. So this is the expectation from the side of the borrower or the firm. And SML from that gives the required rate of return, that is KRF plus KM minus KRF into beta, right? So if these two are equal to KS, then we say that the market is in equilibrium, because both expectations of the investor plus the investor plus the borrower have become same, right? So there will be no buying and selling for the price to be stabilized, right? Okay. Expected returns are obtained by estimating dividends and expected capital gains, which can be found using any of the three common stock valuation approaches, right? So we can use to any of these valuation approaches to calculate the expected returns. Then required returns are obtained from the CAPM, right? So yeah, so you see the same formula there, right? So at equilibrium, when both equal, we say that it's at equilibrium, right? So how equilibrium is established, right? If the expected return, right? If the expected return is greater than the required return, right? Now say K cat S equals D1 divided by P0 plus G is greater than Ks, right? Is greater than Ks. What would happen? The price is too low, right? Price is too low. Okay, price is too low. So G plus the dividend yield will be greater than the expected return, right? So its price is too low means a bargain, right? So people would want to buy. So buy orders would exceed sell orders, right? Then as a result, price would bid up, right? Price would bid up. Price increases so that D1 divided by P0 falls until D1 divided by P0 plus G equals Ks, right? So that is the process that occurs in reaching the equilibrium. Okay, then why do stock prices change? Why do stock prices change? So price equals D1 divided by K minus G, right? So KI or the discount rate could change. So that is required rate of return may change, right? Required rate of return may change due to a change in inflation, right? Here it says inflation premium. KRF is the risk-free rate, right? Is the real rate plus the inflation premium. So if there is inflation in the country, it will have an influence on the prices. G could change due to economic or firm situation. The growth rate in dividends can change due to the economic condition or the firm's condition, right? So that will have an influence on the price. Okay. Then the second part. So we completed the valuation part, and then we said we will look at the efficient market hypothesis also. What is efficient market hypothesis, or EMH? Securities are normally in equilibrium and are fairly priced. One cannot beat the market except through good luck or better information. So what is meant by, expressed by the efficient market hypothesis is that securities are correctly priced, so that nobody can earn an abnormal profit by say, because information is reflected in the price, so that nobody can use information to make a profit, right? That is what is called the EMH. Then it can be divided into three forms. First is weak form EMH. Can't profit by looking at past trends. Can't profit by looking at past trends because all the past information is incorporated in the current price. A recent decline is no reason to think stocks will go up or down in the future. Evidence supports weak form efficient EMH, but technical analysis is still used, right? So even though we say that all past information is incorporated in the prices, and by looking at the historical behavior of the prices, we will not be able to correctly forecast the prices till technical analysis is being used. So technical analysis in simple terms is, it's called charting, because you look at the behavior of the price movements in the past, right? Because technical analysts believe that past will repeat, right? So they will observe the past behaviors and based on that try to forecast the future, right? Then semi-strong form EMH. All publicly available information is reflected in the stock prices. So doesn't pay to go over annual reports looking for undervalued stocks. Largely true, but superior analysts can still profit by finding and using new information, right? So all publicly available information is reflected in the stock prices. So in the weak form, all historical information is incorporated in the stock prices. So in semi-strong form, all publicly available information is reflected in the stock prices. So no one can use publicly available information to make a profit, but still superior analysts can still profit by finding and using new information by analyzing the available information, right? Third is strong form EMH. All information, even inside information, is embedded in stock prices. So this may not be true, right? Not true. Insiders can gain by trading on the basis of inside information, but that is illegal, right? That is illegal and unethical. Yes. Then, so it's all about now this is EMH is about forecasting prices, and now we move on to valuing. Sorry, no, we didn't yet, not as yet. So markets are generally efficient because 15,000 or so trained analysts, MBA, CFAs, technical PhDs are there, because there are a lot of trained analysts and who works for firms like these big companies, have similar access to data. Thus, news is reflected in prices almost instantaneously. So markets are generally efficient. We are not talking about Sri Lankan market, but the world markets, right? So because there are trained analysts and there are these companies have hired the best analysts and have similar access to data. So we can see that news is reflected in prices almost instantaneously. Then we move on to the next type of shares, right? Next type of shares, that is, we were discussing valuing of an ordinary share. Now let's look at how to value a preferred share. Okay, you call it a hybrid security because it has a characteristic of a debt security and has characteristics of a common stock also, right? You call it a hybrid security because preferred stocks at the time of issue are secured with a fixed percentage of dividend. They are promised with a fixed percentage of dividend, right? So similar to bonds in that preferred stockholders receive a fixed dividend that must be paid before dividends can be paid on common stock, right? However, unlike interest payments on bonds, companies can omit dividend payments on preferred stock without fear of pushing the firm into bankruptcy, right? So they can omit dividends. So if there is a cumulative provision, they will have to pay the past dividend when they start making profits again, right? So since they have characteristics of both debt and equity, you call it a hybrid security. When it comes to preferred shares, these can be based on the cash flows. We can divide them into two: redeemable preference shares and non-redeemable preference shares, right? Redeemable and non-redeemable preference shares. So what's the expected return of a preferred stock with value of 50, an annual dividend of 5, right? What is the expected return? Right? Value is 50, annual dividend is 5, right? So what is KP? We can solve for KP by taking KP to the left-hand side of the equation and taking 50 to the right-hand side of the equation. So KP becomes 10%, right? Then how to value a preferred share? If we take the general valuation formula that we used so far in valuing ordinary shares and bonds, we can identify the cash flows generated by a preferred share, right? So if it is a redeemable preference share, we see two types of cash flows. First is the dividend flow, which is fixed. And second is the amount of money paid at redemption, right? The amount of money paid at redemption. Okay, so we can take the present value of the dividend flow, the summation. Here, what you see here is summation of the present values of the individual dividends until maturity or until redemption. And RP is the redemption price, can be discounted to the point, right, say to today's value, and then you can add that together, right? So present value, yeah. So it's like a coupon bond, right? Coupon bond with maturity. Then there is one example. ABC PLC has issued preferred stocks at 100 par with 20 years to mature. It pays 12% dividend annually. If the investors require return of 16% per annum, what is the present value of this preferred stock or the price of the preferred stock, right? So you have two types of cash flows. You have two types of cash flows, the dividend flow and the redemption price, right? If the redemption price is not given, we believe that the stock is redeemed at par value, right? Par value or the face value, right? So it pays 12% dividend annually. So preferred stock has a par value of 100, pays 12%, means annual dividend is 12 rupees. 12 rupees received for a time period of 20 years can be treated as an annuity. So we can use the present value of annuity formula for 20 years at 16% to calculate the present value of the dividend flow, right? Present value of the dividend flow. So 12 into 1 minus 1 over 1 plus r to the power n divided by r, right? So 12 is the dividend, 1 minus 1 over 1 plus 0.16 because the discount rate is 16%, and to the power 20 because n is 20. So divided by r again means divided by 0.16. Plus, this is the present value of the dividend flow plus the par value discounted at 16% for 20 years will give us the present value of the par value, right? 100 divided by 1 plus 0.16 to the power 20. So when you add these two together, you get 76.29 as the price of a redeemable preference share, right? Redeemable preference share. So what if we talk about a non-redeemable preference share? A non-redeemable preference share. Non-redeemable preference share means you will have a dividend flow forever. You will have a dividend flow forever, right? So if we take the same example, you will receive 12. Yeah. Yes. Preferred share with the maturity. So at maturity, you redeem them, right? You redeem them by buying back, right? You pay the preferred shareholder and buy back the stock, right? So, preferred share without a maturity means you will receive a fixed dividend forever, right? So if you take the same example, 12 received forever. So what you can do is 12 divided by the interest rate or the discount rate will give you the present value of the perpetuity. You can treat it as a perpetuity. So 12 divided by 0.16 will give you the present value of a redeemable preferred share, okay? If it is redeemable, if it is a non-redeemable or preferred share without a maturity, right? I don't know whether I mixed it up for you. So if it is with the maturity, you will have two types of cash flows, the dividend flow and the value at redemption, right? If it is a non-redeemable preferred share, right, which will stay forever, right, once issued. So you take, there will be only the dividend flow. Dividend flow is in the form of a perpetuity because dividend is fixed for preferred shareholders. So we can treat it as a perpetuity and divide the dividend flow by the discount rate and take the present value and we can call it the price, right? Yeah. So there are some exercises. Yes. Yes. Yes, shall we start with the first one? Suppose you plan to accumulate 10 million at the end of 6 years and deposit equal amounts at the beginning of each year, an additional deposit of 2 million at the end of year 3. If the intermediary agrees to pay 12% interest per annum, how much is the value of a deposit, right? So suppose you borrow 12 million that is to be paid with 10 equal annual installments. The interest rate charge is 12% compounded quarterly. How much is the value of an installment? After paying installments for 5 years, you decide to settle the outstanding balance of the loan at the end of year 6. How much should be paid, right? So this, you can use the amortization table to do that. Then last year, stock of a listed company paid 5 as dividends, and investors expect that the dividends will grow up by 5% in the future. And the beta of a stock is 1.2, and the risk-free rate and the market expected returns are 9% and 14% respectively. Estimate the required rate of return of the stock using the capital asset pricing model, right, or the SML formula. Calculate the value of the stock today. Calculate and analyze the behavior of stock price in the changes of dividend growth rate of 4% and 6%. and the risk-free rate of 8% and 10%, right? So I think this can be easily done because this is what we have covered today, right? Then an organization is planning to issue 2 bonds, 2-year 10% annual coupon with 1,000 face value at the end. The second one is 10-year 10% annual coupon bond with 1,000 face value at the end, right? One is 2-year 10%, the other is 10-year 10%, right? If investors' required rate is 10% from the 2-year bond and the 12% from the 10-year bond, calculate the prices of the bond today. If the expected inflation rate go up by 1%, which causes required rates to go up by 1% for both bonds, calculate the new prices for both bonds today. So briefly explain the risk exposures of these 2 bonds to an investor, taking the behavior of prices on the change of required rate of the 2 bonds above into consideration, right? So you can calculate the prices, and you can see how the bonds with different maturities respond to price, right? So these are exercises for you to do. Yes, anything you want to clarify or you want to ask? This is the time for that. Yes, I can see 60 people.
Madam,
Yes.
is it possible to try a past paper question, just the calculation, not the theoretical things relevant to your area?
So can you give me a past paper?
2020 past paper?
2020?
Yes, the most recent one, madam.
Yeah, I'm not sure whether you have it.
Yes, madam, we have it.
Yeah.
So shall I put it in the chat
Yes,
here?
yes, please do it. Please do.
Okay.
Yeah, Kavindari Ratna, what do you mean by this message? I'm sorry, I cannot understand it.
Madam, that was the password for the paper, which I
Okay.
shared with you.
There is a password also.
Yes,
Is it?
ma'am.
Okay.
So you can just copy and paste it.
Okay. Yeah. It says password is incorrect. Yeah, it says password is incorrect. Let me have a look and see whether I have that. Can you please open it and then copy and paste question 2 only? I think it's question 2, isn't it? Can you please do that favor?
Okay, madam, I'll do that.
Yeah, thank you very
Madam,
much.
password is correct, madam. It can be.
Mm. Yeah, but if I can have only that question, we can discuss, no?
Okay, madam.
Yeah. I'm sorry. It doesn't work on my computer. Yes, slide 40. Slide 48. Right. So see, it's the expected rate is yeah.
Madam, I have put it into the chat box.
Okay.
2021.
Thank you very much. It's this, isn't it?
Yes, madam, it was the question number 2.
Yeah, yeah. So your father has a block of land which he intends to sell after advertising in the internet. He has received few offers from prospective buyers. Some have offered to buy outright for cash and some others have requested for installment payments. Advise your father in choosing a buyer, explaining the concept of time value of money. Now, what you have to emphasize here is the reasons for time preference for money. Like say, if your father can sell it outright, he can have the money today, he can consume it, he can invest it, or I'd say he can use it for other alternative purposes. So if he has to wait for 1 year, he is delaying his consumption and he is foregoing his investment opportunities that he can make today. So you in your advice to your father, you must mention the 3 reasons for demanding money today rather than at a later date, and explain him about the price or the time value of what is time value of money and what is called interest rate, and why should people ask for a compensation for delay. Like say it's only for 3 marks, right? So if you give a brief description of why there is a time preference for money and why should he ask for a higher price if he is agreeing to receive it at installments, can be, if that is explained, that is all right, right? Briefly explain the relationship between bond prices and interest rates. So relationship between bond prices and interest rates, it's an inverse relationship. It's because now in general interest rates, you use the general interest rates to discount the cash flows. We say value of a bond is the present value of the expected cash flows. So if you discount it at a higher price, then your present value will be lower, right? So that is the inverse relationship. And the other thing is, other general explanation is, when general interest rates are higher than the bond's coupon rate, then people would try to sell the bond and then go for alternative investments at higher rates. So that will create a supply greater than the demand and the price would come down. And if general interest rates are lower than the bond's interest coupon rate, then people would look at it as a lucrative investment and the demand will be more for buying orders rather than people who want to sell. So it will bid up prices. So at lower interest, general interest rates, bond prices will be high, and at higher interest rates, bond prices will be lower. So there is an inverse relationship, right? That's the second question. Tiny Kites is a local confectioner producing and selling jujubes, toffees, chocolates, and jelly beans. They are planning to introduce a variety of gummy candies into their production, as they felt that there exists a demand for that from parents of small children. At the initial stage, they are thinking of introducing a bear-shaped gummy in 3 flavors. The machine which can produce these come in different brands and different capacities. Tiny Kites has collected the following information of a machine that estimated the future cash flows. Initial investment is 160,000, lifetime is 4, annual net cash flows 80, 80, 40, 40. So this lifetime is 4. For during that lifetime, for the first year, they can get 80,000, second year 80,000, third year 40, and fourth year 40. Tiny Kites is planning to obtain a bank loan for purchasing the machine and has negotiated with the bank to obtain a loan of 160,000 to be paid off in 4 equal annual installments. So would you recommend this investment? Explaining the NPV of a project. Yes. Would you recommend the investment? Explain using the net present value. So first of all, initial investment is 160,000, and if you make that investment, these are the cash flows that you would receive, right? You would receive. So what you can do is
Madam, here the net cash flow means after deducting the loan in installments or before deducting the loan installment?
That is, net cash flows are after deducting all expenditure. That is why we call net cash flow. So initial investment is 160,000. That's in its real value, right? I'm looking for the discount rate. So discount rate is not there to be seen. So show the loan amortization schedule indicating how the installment is being paid between capital. Yeah. I think from that we can take the from that we can take the yes, the interest rate. What is the second part of the question? A is, would you recommend this investment? Explain using the NPV. What is part B? Can you please read out?
Madam, in the part B, it's mentioned like how much should the loan installment be if the interest rate charged by the bank is 10%.
Okay. So since we have 10% in that, yeah.
So we have to discount it by using 10%.
Yes, we discount it by using 10%. So 80% discounted for 1 year. Sorry, 80,000 discounted at 10% for 1 year, 80,000 discounted for 10% for 2 years, 40,000 at 10% for 3 years, 40,000 at 10% for 4 years. And you add all that together, you get the net present value, present value of cash flows. Compare it with 160,000. If 160,000 is greater, we are not going to recommend it. If 160,000 is lesser than the amount that we calculate, then we are going to recommend it, because we say explaining using the NPV of the project. Net present value is the present value of cash outflows, the difference between the present value of cash outflows and present value of cash inflows. So this is present value. You can calculate the present value of cash inflows. Compare it with present value of cash outflows, because initial investment we are still considering. If we do it today. So there is no adjustment required for 160,000. So compare it with this, calculate the NPV, and based on the NPV figure, you can recommend or recommend whether to accept it or not. Okay. Understand?
Yes, madam. It was
Okay.
understood.
Yeah, the second one, the second question is what is the initial installment, right? What is the what is the amount of the installment? If you obtain a bank loan, now you will obtain 160,000. 160,000 is the present value, isn't it? 160,000.
Yes, madam.
Yes, 160,000 is the present value. And if you take now, since it's in a installments are fixed. Normally loan installments are fixed. So present value is 160,000 equals the cash flow into present value interest factor annuity formula, right? That is 1 minus 1 over 1 plus r to the power n divided by r. Okay.
Okay, madam. Okay.
Yes. So 160,000 is the present value. You have equals cash flow into 1 minus 1 over 1 plus r is 10%. To the power n is 4 divided again by 10%. Right? So when you simplify it and solve for cash flow, you will get the annual payment. Do you want me to do it?
No, madam, it can be managed.
Okay. Right. So that is how you find the value of the installment. So once you have find the value of the installment, the initial amount is 160 and payments will be made after 1 year. So 160 plus 10% will be the total amount due, and you deduct the first installment from that, right? So the annual interest, that is 160,000 at 10%, that is 16,000. That is the first year's interest, right? Like we did the amortization schedule. Yeah, so that is this is the only question that is relevant to what I have taught last year. You have the paper the previous to this. Oh, there is another one. There was a question on bonds also, right?
Yes, madam. Yes, wait. So that is also there. Did you receive it, madam?
Yes, yes. Yes, let me. That is- I cannot open it either from Word or from PDF version. Why? File has been damaged, it says. It has been damaged. What am I to do?
Madam,
Yeah,
could you please explain this answer by using whiteboard or something?
sorry.
Could you please explain this answer using whiteboard or something? Right
My
answer.
only thing is whiteboard. I don't have a pen. But I
Pen.
can, if I go to the whiteboard option, I have this problem of using the pen. So let me, yeah, which one you want? You mean this example that we discussed, is it?
Yes, madam. Some
Just what we just discussed?
calculation.
Okay.
Yes.
Okay. I will open the PowerPoint and then try to
Yeah,
explain.
yes, madam. Yes, madam. It's great.
Madam, again, I sent you a file. So can you check it again?
Yeah, I'll check it again. No, the previous one I could open with PD, Acrobat, but this one it says no. I don't know why. Why is that? Okay, okay. First, yeah, let me explain this earlier sum to you, right? Let me explain that, because, yeah, yeah, yes. Which one, which part is it from the first one? Now, calculate the NPV. First part, that is 160,000 is in its real value, is a negative cash flow, right? Is the negative cash flow. Is a negative cash flow, and you have 80,000. Sorry. You have 80,000 and again another 80,000 and again the 40,000 and another 40,000, right, as cash flows. So what you are supposed to do is discount these cash flows. Sorry. discount the cash flows and find the present value, right? You discount it at 10%. So first one, you divide it by 1.10 to the power 1 because you are discounting it for 1 year, right? Then the second one, you are discounting it for 2 years. Divide it by 1.10 to the power 2, right? Then the third one, you are discounting it for 3 years.
We can see the only question.
Sorry?
You are writing something. We can see the only question, madam.
Oh, okay. I have to share. Yeah. Sorry. Sorry. Sorry, I'm sorry. Now, is it okay?
Yeah, we can see, madam.
Okay. Yeah. See? Oh, sorry. Yeah, I hope you can see now. So cost is 160,000, which is the negative cash flow that would occur today, right, at present. So, and the positive cash flows that would occur in future. After 1 year, it's 80,000. So we discount it for 1 year. Second year, 80,000, we discount it for 2 years. This we discount for 3 years. Discount for 3 years. Plus this last 40,000 will discount it for 1.10 to the power 4, right? So we add these together, compare it with this one, right? So net present value is present value of cash inflows minus present value of cash outflows. Outflows is 160 plus this we have yet to calculate. I cannot remember the answer. So if the outcome is positive, recommend the project. Recommend the project. If the outcome is negative, if it is negative, do not recommend. Sorry. Negative, do not recommend. Okay. Is it okay?
Okay, madam.
Okay. So next is, now they say that to get this 160,000, they are going to obtain a loan, right? So present value of the loan is 160,000 because if we receive it, we are receiving it today, right? So we are paying it in 4 equal installments. 4 installments, right? So normally we know that loan installments are fixed, right? So we can treat it as an annuity. Treat as an annuity, right? So we take the present value of annuity formula. Present value equals cash flow, right? Annual cash flow into 1 minus 1 over 1 plus R to the power n. Divide the whole thing divided by R, right? So this is the formula. So we can apply the figures, right? Now present value of the loan is 160,000, which is known to us, right? Equals, now we are supposed to find the cash flow. What is the annual payment? 1 minus 1 over 1 plus R. R is 10%, isn't it? 1.10 to the power 4. Because we are paying it in 4 equal annual installments to the power 4, right? Divided by R is 0.10, right? Sorry, 0.10. So you have to first simplify this. Simplify this one, simplify this and take it to the other side of the equation So multiplication becomes a division. So 160,000 divided by this will give you the value of the cash flow. So can anyone give me the cash flow, please? Quickly.
Madam, since we have the calculation, we can sort it out. No issue, madam. So shall
Okay.
we go to the next one?
Yeah. Yeah.
Okay.
So that is after finding this, all what you have to do is 160,000 plus 10%, that is 16,000 will be the outstanding balance at the end of the first year. Okay, 50,475 and 33 cents, right? So put it in a table or like we did. This is the opening balance plus interest is 16,000. So balance will be the total of these two minus the installment. You take the balance to the beginning of the second year. And based on that balance, not based on that balance, you have to segregate between interest and principal payment included in the installment, right? And then calculate the beginning of the second year balance. On that 10% interest will be added, and then only you deduct the second installment. I think if you refer to the example that we did, you can easily understand 50,000. This is 50,000. 50,475. 50,475 is the installment cash flow, right? So he will pay 50,475 annually for 4 years if they decide to obtain this loan, right? So for like amortization table, I think if you can, I think if you look at the example that we did, you will be able to understand, right? And what was the other one? It's the bond question, isn't it?
Yes, madam. So I have sent you another PDF.
Yeah, I'll try. I think this time it's okay. It's a PDF. Yeah. Yes, get it. So how much should be the loan installment? Interest rate is charged by the bank is 10%. Show the loan amortization schedule, indicating how the installment payment is divided between capital repayments and interest payments. So any questions on that? It's clear, I think. Is it? Yeah. One of your friends, Sarath, has joined an investment advisory service company recently, and one of their major clients have requested him to conduct an investment seminar to his staff. Your friend seeks your support in this matter. To illustrate the common stock valuation process, your friend has asked you to analyze ABC PLC. You are to answer the following questions. Describe briefly the rights and privileges of common stockholders. I think you can extract it from the note. Assume that ABC PLC is a constant growth company whose last dividend, which was paid yesterday, was ₹2, and whose dividend is expected to grow indefinitely at 6% rate. So D0 is 2 and G is 6. What is the firm's expected dividend stream over the next 3 years? So last dividend is 3, 2. D0 is 2, right? So you are supposed to find D1. What is D1? That is 2 into 1.06, right? And D2 will be D2 will be 2 into 1.06 to the power 2, right? D3 will be 2 into 1.06 to the power 3. Agreed? Is it okay?
Yes, madam. Clear.
Okay. What is the firm's current stock price? Now, if it is a constant growth company, right? So we can easily apply what is the price? Say P0 equals, this is going to be D1 divided by KE minus G, right? Because it's a constant growth company, right? What is D1? D1 is 2 into 1.06, right? This D1 divided by KE is how much? From the upper, isn't it given?
Yes, madam, it is not given.
Okay, so let's take it as 10% then. Let's take it as 10% because it's given as a continuation of the previous sum. Maybe they expected us to take 10%. So let's take it as 10%, right? Take it as 10%. KE is 10% minus 0.06, right? So if you simplify this, you get the price of the stock, right? So next one, what will be the expected price of the stock 1 year from now, right? What is the expected price of the stock 1 year from now? That is P1. P1 equals D2. D2 divided by K minus G again. K minus G, right? Because it's a constant growth company. So we have D2 is 2 into 1.06 to the power 2 divided by, we assumed it was 10% minus 0.06. Okay. So, right. So this is price at year 2.
Madam, we can multiply P0 by the growth rate also in
Of
that
course,
case.
we can do that because it's a constant rate. We can do it. We can take P0 multiplied by 1.06. Then you will get the same answer. Then what would the stock price be if its dividends were expected to have 0 growth? So what would be the price of the price if it is 0 growth, which means 0 growth is constant dividend, right? Constant dividend is, if it is a constant dividend, 0 growth is 2 divided by discount rate. We took it as 10, right? Because it's going to be a perpetuity. Okay. Okay,
Okay,
that's
madam.
all.
Okay,
Yeah?
okay, madam. Thank you so much.
Okay, anything else? I'd say I think if you go back 3 years, it would be okay. Don't go beyond that, right? I mean, in working past papers. So if you find anything not clear when you work the exercises that I have given you or the past papers, you can always contact me through my email is champa at sjp.ac.lk, right? So, sorry, M is necessary. So M, what is happening? Yeah, jump at stp.ac.lk. Okay. So if there is any problem or any, if you need any clarification before the examination, you can always contact me through the email, right? Okay. Slide 48. Slide 48. Yes, if expected dividend, expected case, right, is greater than, like say, this is greater than the actual rate, right? The required rate. Required rate of return is less than the expectation is greater, right? So it is greater means G plus this one. So this fraction will be bigger if the denominator is small, right? If the denominator is smaller, this proportion will be bigger. Added to growth rate, so it says it's greater, right? So it has become great because price is more. Price is too low. The denominator is small and this whole figure is big, so that it's greater than the required rate of return, right? So that is price is low, right? So price being low, but then the value is a bargain, right? So people would want to buy. So buy orders will exceed sell orders. So when the demand for that instrument is more than the supply, prices will go up, right? So prices will go up, and as a result, this becomes now prices will go up, and this becomes smaller until it becomes equal. Until it becomes equal. Is it clear? You see, maybe the person who asked is not here. Okay. 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 Right. So I think it's all for today. And next week, Dr. Anuradha will take the class, and you will receive a Zoom link separately from her. Right. So wish you all the best. And as I mentioned, you can always ask me for clarifications or whatever support you need before the exam by writing to this email. Okay, thank you very much then.
Okay, madam. Thank you so much.
Okay.
Thank you, madam.
Okay.
Thank you, madam.
Okay.